Successful real estate investment has long been a tried and true method of accumulating wealth. Purchase or acquire land title and improve the property's agriculture potential so you can charge a greater rent. Here, we will show you some of the most popular strategies to succeed in real estate investing. Number 10. Increase your savings and improve your credit score. Some say that you can start investing in real estate without any money, but we strongly disagree. Our experience has shown that real estate investors with money and a strong credit have the finest prospects and the most alternatives, so don't put it off any longer. Get started on this stage straight away. Since the acquisition of real estate almost always requires cash financing, always ensure your credit record is correct and positive, as sellers won't provide funds to a buyer with a poor credit profile. Your credit score is important not only for obtaining real estate loans, but also for negotiating the finest conditions to make the most out of your borrowed funds. Obtain a copy of your credit report and make any necessary corrections as soon as possible. At the absolute least, request that a credit reporting agency includes your comments in file along with your side of any disagreements. If real outstanding sums emerge, make payment arrangements and provide written updates to the credit reporting company demonstrating that the debt has been paid or otherwise properly addressed. Number 9. Invest in real estate that is moving in the right direction. Locate homes in regions that will continue to improve as a result of increased investment and commercial activity. Considering that you won't be able to physically relocate your property, a thorough examination of the place and its future possibilities is essential. Following the discovery of the greatest cities or neighborhoods, you should search for two categories of underperforming real estate holdings. First are physically sound but badly maintained, and second are weary and worn and have considerable deferred maintenance. Your preference will be determined by your unique skills and resources. Properties that haven't been adequately maintained visually or where the present owner or management hasn't kept rents at market levels are particularly appealing. Number 8. Purchase the greatest home for the best price. Always try to get the greatest deal on a property. This technique is straightforward and makes a lot of sense, but it may be more difficult to implement than it appears. We recommend adhering to a few principles. You should acquire properties that perhaps have unique difficulties but fit your abilities so that you may utilize them to improve the property's worth and raise the net operating income over time. Since the valuation or appreciation to date has already accumulated to the existing owner, a real estate investor utilizing the get-rich-right technique won't acquire a new or fully renovated property unless it's on the path of development or in a good location. These homes may be good investments, but you're just getting market rent and value gains. Number 7. Renovate your home properly. The get-rich-right method is based on locating properties on the path of advancement and then remodeling them to enhance cash flow and value. However, don't go overboard on physical enhancements. Only make improvements or upgrades to the property that will increase its appeal to your target market. It is a rented property, not your own house. You may want to upgrade your home with high-end countertops and appliances, but if you over-improve your rental property, you won't get a satisfactory return on your investment. Although pride of ownership is essential, you are operating a company, and overpaying on one home will restrict your capacity to save for the next down payment and grow your portfolio, limiting your ability to reach riches. Although performing the work yourself is usually less expensive, don't forget to factor in time and experience. It makes no sense to take a rental property off the market for 3 weeks while you spend your nights and weekends painting in the erroneous hope of saving $1,000 on a painting that would take a professional contractor 2 days and allow you to rent it this weekend. In addition, a professional contractor will almost certainly perform a better job than you. Number 6. Keep up with the market rents. For most rental property owners, finding the appropriate rate to charge renters for newly refurbished rental apartments is one of the most difficult tasks. This element of property ownership and administration just needs a little study and preparation. Every property is different, but a market study of comparable homes can provide you the greatest indicators of the market worth of your restored home. To demonstrate your appreciation for their long-term tenancy and to encourage them to stay, we propose keeping the rent slightly below the full market rent for current long-term renters. The cost of losing a tenant is high. A vacancy means lost income that you won't be able to recover, as well as the additional costs of promoting and preparing the rental property for the next renter. Number 5. Refinance to get your remodeling money back. One of the most important aspects of the Get Rich Right plan is to keep your money functioning and to utilize leverage responsibly while preserving enough equity to withstand real estate cycles and local economic problems. You spent money to buy and renovate your rental home, but you also boosted the revenue, which raised the value. This improved worth can now be used to refinance the property to meet your acquisition and remodeling expenditures. Although we constantly warn against overborrowing and over-leveraging your real estate assets, you also don't want to be overly careful and underfund your cash demands. The cost of refinancing is such that you wouldn't want to do it more than once every few years, and the prices of short-term funding might be significant if you suddenly need money to deal with some unforeseen issues. Borrow more funds or have an unused line of credit, which some lenders give at no cost to their best clients to recover reserves. Remember that real estate markets go through cycles, and you don't want to go too aggressive and find yourself unable to even afford to rent one of the units you used to own. Number 4. Better tenants are needed to reposition the property. Repositioning the property with new, more financially suitable tenants is one of the greatest methods to enhance the revenue and value of your recently restored real estate investment. As a result, consider marketing to a new target tenant profile and re-leasing the property to enhance your renters. Even if you can work around the present tenants' agreements, your remodeling efforts will most likely evict them. The present renters might be the reason why the prior owner decided to sell the home. Such tenants are unlikely to change their behaviors overnight and will continue to misuse the property without respect for your investment. Number 3. Become a great property manager or hire one. In the long term, superior management creates the difference between ordinary and great results. You must retain renters and reduce turnover after renovating and repositioning a property with new tenants at higher rents. You may also increase net operating income by reducing expenditures effectively and efficiently. Even if you've just purchased a new rental property, you should continue to work on your long-term investment plan by properly running and maintaining the property to maximize value, as if you were refinancing or preparing the property for sale. Number 2. Mortgage or sell and postpone again. Even though property values in most regions fell in the late 2000s and early 2010s, many rental property owners discovered that they have a significant amount of equity in their property due to the appreciation across most of the country over the decades. Having some equity in the property is beneficial and prevents you from losing money if the local real estate economy suffers a setback, but having too much equity in a property reduces overall profits. Our Get Rich Right method suggests that you use the equity in your present properties to diversify your real estate holdings by investing in other properties to lower your overall risk. You may either conservatively refinance your rental property or try to sell the real estate investment in a tax-deferred exchange to access that equity and produce the cash you need. Market conditions determine the optimum choice. We recommend that you refinance your stable long-term properties when attractive financing circumstances become available. You may put the money back into your capital account and utilize it to buy other rental properties or make other investments. The best part is that you may take cash equity out of your homes without paying taxes on it. Borrowing isn't damaging if done responsibly. Number 1. Consolidate your possessions into a single bigger property. Many real estate investors, fortunately, have mastered the basics of purchasing and upgrading rental properties. However, they frequently grow so wealthy that their real estate business takes over their life. Although having a diverse portfolio of rental properties has its benefits, there will be a time when your large real estate assets become a managerial burden. The majority of long-term real estate investors reach a point where their management obligations and duties no longer align with the lifestyle they can afford. They frequently choose to simplify their life by hiring professional property managers to handle the 4 T's that are tenants, turnover, toilets, and trash. That's it for today's video. Thank you for watching this video until the end, and we will meet you in the next one.